All right, thanks for having me. I've been running a hedge fund for 18 years, based in San Francisco, and I'm going to go through some of my thoughts about where I think this space is in the institutional markets and what to expect, but also how I think about this in a greater context outside of crypto and blockchain and finance, because I think that's vitally important. Okay, the first thing is what I've learned over 18 years is that markets are actually not as good at discounting the future as people think. They're better than governments, they're better than other systems, but really when you have something dramatically new, something that's never happened before, markets take a long time to recognize that value. So what I have, my philosophy that I've developed is three things. I want to invest in things that have never happened before. To me, that is the path to making a lot of money and anticipating things that people later will come to understand and believe. Second is whenever there is liquidity events, whenever there's a cash crunch, whenever there's a scare, things regress to a mean. Something up will go lower. And you need to hedge for that. You need to plan for that. But lastly, what I've learned is that you need to plan for the unimaginable. The unimaginable just keeps happening, I find, and every time it's a surprise to people. You should plan for that. So when I started in markets, I was an analyst in San Francisco in an emerging market hedge fund with $2 million in 1996. And between 96 and 98, what happened was professionally, I was in this new asset class called emerging markets that went up and then crashed spectacularly in the end of 97, 98, and no one predicted it. And sitting in San Francisco, I was in a tech bubble all around me where stocks went up 10, 20, 100 times. They went up that much here too, and no one predicted it. And so when I started my firm with less than $1 million, my basic belief, my hypothesis was maybe markets are not that effective at predicting things that have never happened before, particularly with new asset classes. So I'm thinking about that now and where we are with this market. So I'm just going to go through. I'm a thematic investor. I try to get ahead of big trends, big inevitable trends, and some of them started when tech and telecom was everything in the market, and I had just been through the emerging market crash, and I thought this is a bubble that's going to crash too. And I was short. To avoid the market, I went looking for something that was so down and out that it couldn't go down, and that was energy that had topped 20 years before. I got long energy. I didn't know anything about it, but I learned. I hired people. I think there were 6 energy hedge funds in America in 2001. In 2002, I got long gold when Greenspan wanted to avoid a recession and devalue the dollar. I got long mining as an extension of gold. And in 2003, we learned that China was a big demand driver for mining. The market had no idea. Also in 2003, to avoid the US, I started investing in India, the other country with over 1 billion people. And that was a great time to do it. India had gone sideways for 10 years, and no one was interested when I started investing. Then it became clear China was a huge demand driver, something that never happened before. And so I started going long Chinese consumer names. And the biggest trade that I had was going short subprime mortgages. I started doing that in 2005. I lost money throughout 2006 and started making money in 2007 when 20% of the first mortgage buyers defaulted. That's how stupid markets can be when liquidity goes one direction. Anyway, what I found is, I can go through this list, what I found is that there's an unending string of big things that have never happened before, which you want to invest in, yet you have to give up certainty, precision. You have to basically be directionally and significantly right and go that direction and learn and try to figure out what is on the other side of that. What's happened for me is that having been through, since the crisis, massive government intervention in markets and the economy, I think we're at a point of change. And my big macro thesis and view now is that the era we're in is now where technology is going to change all the big sectors, the big industries in the world. And the big industries in the world essentially happen in every country almost, happen all over the world. I can tell now, the last couple of years, I can tell the whole world is feeling these changes. The whole world has come to accept that technology is changing their industries, their countries, and they have to figure out what is going on, and they have to get closer to it. That's what I'm seeing global investors think about. So I'm going to put, when I talk about cryptocurrencies and blockchain in this whole space, I'm going to put in context for this big macro trend that I see, which is now all these big sectors that didn't change very much despite the internet being 24 years old are now going to change. And I think it's going to happen in the next 5 years. So I'll call blockchain and crypto a massive change, a technological breakthrough in finance and eventually commerce. How much bigger of a sector is there really than finance and commerce? Now it's going to enter different parts of finance and different parts of commerce at different times. But after putting in about a year of my time into this, this is what I see. I think this is just a technological breakthrough and more difficult for institutional investors to comprehend a cultural change, which is very unusual in any finance professional's career to accept. It's two things. It's technology and it's a cultural change of adoption. But other ones that I'm investing in and thinking about are healthcare, and that is the biggest industry in America. And genomics is a massive technological breakthrough that has been happening over the last 15, 20 years. No less significant, really, but the implementation of it is going to take a lot of time in the regulated industry of healthcare. Another one is autonomous driving for transportation. Again, unthinkable just a few years ago, but this is what we're dealing with. Transportation, an enormous industry, and we're now looking at a future where cars are going to drive themselves. There's a company a two-year-old company in Menlo Park in Silicon Valley called Katera that is productizing and digitizing every single part of house construction, multifamily construction. They can build up to 10, 12 stories. They're basically becoming an Amazon for construction, and they think they can make costs of houses, not sacrificing quality, 50% cheaper. It's a radical thing for a multi-trillion-dollar market of construction. There will be many others who do this. It'll take a long time to enable this change in construction around the world, but it is happening. It is going to happen. And then finally, artificial intelligence is a path to where machines decide everything. Machines write software. Machines tell you what to do. This is the path we're on. This is the era we're in. So I'm going to preface I'm saying all these things because institutional investors are cautious by nature. They're fiduciaries. They can get fired. They can be sued. They take things carefully and cautiously. But the era we're in right now is an era where this is happening in all the biggest sectors. This is an era that's never happened before. And crypto and blockchain is part of this era. And therefore, we're going to have to deal with this. And what's interesting is that individuals are dealing with a lot faster and better than institutions. And so I'm going to talk about some of the issues here. So to examine just two of these different sectors, here's the cost of genomics, sequencing a genome. The green line is Moore's law, what the cost would be with Moore's law. And here's what the actual cost was, and you can see the list. We're down to about $100 a genome. Actually, Dubai just announced in the last month that they're going to sequence all 3 million citizens. First time any country has decided to do it. I think the actual cost will be $35 a person. Really, really cheap when you consider it. Now, there aren't the systems available to process it. The cost has actually dropped so much faster than expected that the market, the ecosystem, can't really do a lot with it. The ecosystem is going to have to catch up. In a way, it's a lot like what's happened with crypto, right? The ecosystem has produced something which has gotten adoption, and the institutional world, the regulator world, has to catch up. Autonomous driving, it's really shocking to me how fast this is going. So this is, it's hard to read, but level 3 is called conditional automation. And it says, in the right conditions, the car can manage most aspects of driving, including monitoring the environment. The system prompts the driver to intervene when it encounters a scenario it can't navigate. So basically, you have check marks for Germany and the US, where it's about to be legalized, and in most of or all of those countries, you have X's in countries where it's not. That's a lot like the regulatory environment right now in the world for crypto and blockchain. The point of this is to say that what's happening in this space is not happening, it's not some outlier. It's part of this technological, this is just the tail of all the investment that went in, all the human capital that's been released because of the internet, because of globalization. This is just the outcome that's happening in finance and commerce. But it's going to take institutional investors a while to get comfortable with this, just like it's hard for you to get comfortable with autonomous driving. That's about how institutional investors feel about this asset class. So none of these big changes in the biggest sectors are operating at scale. And yet, you can check for yourself what you think about each of these versus what you thought a year ago or 5 years ago. 5 years ago, getting your genome sequenced didn't seem like it really mattered to me. And autonomous driving was off the table, not happening in 20 years. Now it feels quite different, right? The unimaginable is now in front of us. 5 years from now, we'll look back, we will have digested, the world will have digested all of this change, and we will be doing things in very different ways in most ways of our lives. So when I think about this in the context of all these other changes, for investors, actually participating in cryptocurrencies is actually the easiest way to participate in this technological change that's happening in all these big sectors. The only other way that you can actually do anything, I'd say, in these big things is get your genome sequenced, sign up for 23andMe or Color Genomics. I'm investors in both those two companies, and learn something about yourself. Maybe it could be your susceptibility to a cancer. Maybe it's where you're from. Right now, the system can't do that much. It's not organized around serving your personal need, but you can participate. The other things, you have to wait for broad regulation and wait for big systems to happen. What's interesting to me as a finance professional, having done this for over 20 years, is I believe what's happened in blockchain and cryptocurrencies and crypto finance is more shocking to finance professionals than these other things are to those participants. That's my belief. I think finance people believe that they have so much information, and markets have so much information, and they would have seen this coming, and they didn't. And as evidenced by the rise of Bitcoin and ICOs and Ethereum, et cetera, it just did something that I think finance people haven't seen before. One reason I believe that their finance professionals have a hard time with the price of Bitcoin or the price of Ethereum is because they assume they're securities. They assume they're securities, and a security to a finance professional unconsciously means they have earnings, or they have an asset value, they have some level of growth, that they're tied to the real world in some normal way that a company that issues a security is. And a company that's tied to the real world that issues a security is constrained by how difficult it is to grow in the real world. And so when they see something that rises that steeply, as Bitcoin did or Ethereum did, they just assume it's a bubble, because no security could rise that much or in that way and be real. But these are not securities. And that's what's so interesting to me about this. I look at the price of Bitcoin and the price of Ethereum as really adoption curves. Adoption curves that are gaining on legacy systems that we assumed were the utmost, the end systems, but they're not. In fact, all of these different changes, you can say that we're operating on legacy systems for all these different areas, the biggest areas of the world: healthcare, transportation, finance, construction. We're all in a legacy system. So I look at the price of significant cryptocurrencies as adoption curves. And of course, they regress to the mean when there's liquidity changes. But they're not secure. These are not securities. And so essentially, it's a path to where there's a balance of adoption. And that is far, far away from now. Whether it's Bitcoin or some other store of value coin, it's going to take a long time to get there. One comment on technology platforms: we've seen this many times before. Now, I was born in 1964, and I don't really remember the mainframe era as a professional. But I do remember the client-server era. And in the client-server era, it seemed preposterous that we were going to go into this SaaS and cloud environment. It just seemed crazy. But that's what happened. And now we're going into a decentralized blockchain era. And it always seems crazy to make these massive changes. But that's where we are. This is the era we're in right now. I've been a global investor my whole career. I started doing emerging markets in 1996. I also, first job out of college, I taught English in China in Ningbo University, the first private university in China. I've thought globally as a professional. What I really like about what's happening with blockchain and cryptocurrencies is how global it is. It's not jurisdictionally, no one owns this. China or any country can shut it down, it doesn't stop it. I find that fascinating. In fact, this is just the byproduct of what's happened after the internet's been around for 24 years and globalization has been around for 50 years. This is not going to change. It's only going one direction. Okay, so let's get to some facts about crypto. So there's so little owned relative to other assets that you can't really see it. In fact, if we didn't have it listed, you wouldn't see it. It's $300 billion. That's actually more than what it is, but that's a rough number. 228 trillion is real estate, 100 trillion is debt, 70 trillion is equities, it's really tough for me to call this in a bubble if this is a technological breakthrough on a global basis. This is a list of hedge funds doing cryptocurrencies. And by our math, there's $3.2 billion in crypto hedge funds. There was more at the beginning of the year before prices fell. My own hedge fund had more than $3.2 billion a year ago, actually 18 months ago. So this is just a very, very tiny number. But the big raise, the big change was last year. So it actually gained some recognition last year. Traditional hedge funds have $3.2 trillion. So what are the issues for institutional investors that they're not investing money in crypto hedge funds? Well, I mean, number one is that there were only, looks like, 35 or 40 of them before last year, when there were 167 launched. But regulation, no one knows where the regulatory environment is going to end up. Japan is probably the best country in the world for regulatory clarity. One reason I wanted to come here this week. Second is there's no qualified custodians. How are you going to hold this safely? Who do you trust? How do you do it? You have to do it with this new, different technology. Third is hardly any banks want to deal with this asset, whatever you want to call it, this system, this process. Next is just simply trading. How do you trade it? Why are spreads so wide? How can I trust this firm that I'm supposed to trade with? What do I do? There's nothing institutional about this. And lastly, institutions and professional investors are used to a lot of systems that organize information and distill it where you can buy it or at least find it. And that is actually a hard thing to do other than market caps for the top 100 cryptocurrencies right now in the space. So there are some solutions that are being offered that have taken some time. Right after me, Patrick Byrne will speak about T0, which looks like it's going to be the first security token ATS, we hope this year. But there are many others. I'm not saying that these actual firms are the absolute solutions. It's just that there are answers to each of these questions. And the market is figuring this stuff out. The market is figuring out who to use as partners. And we at Passport are doing the same. And we have been spending this time understanding how to do this in an institutional way. And so this matters to us. We've put in a lot of time. So one slide about what are opportunities for an institutional investor like Passport? Well, this reminds me of hedge funds 25 years ago. We started a fund-to-fund in January this year. It's a way for individual and institutional investor to spread their risk across a variety of managers that we select, we do the work on. I think that's an intelligent product. We didn't know of any when we started this. We started a hedge fund. We're one of the 20-something that started hedge funds this year. We plan on starting a treasury management outfit, and that is to help companies that raise ICOs manage it once they have the cash, once they have the capital, once they have the ether. Because you know what? There's no institutional solution for them right now. We're about to start a venture fund. Now, venture is something I've been doing personally for 10 years in San Francisco, and I'm very comfortable with this. But that is something I think is a key part of this ecosystem. And then lastly, trading. We're looking at funding a market maker, a very, very sophisticated market maker, to take advantage of the the widespreads and inefficiencies that exist when you have all these different exchanges. There are many things to do, but the thing to do for me is to go figure this out ahead of the institutions who need a lot more clarity and time before they do anything. Okay, so this is something I'm sure you know, but I look at this in a couple different ways. Store of value. I invested in gold, as I said, starting in 2002. Bitcoin and a few others are absolutely store of value equivalents. In a digital era, this is, I think, what is going to be desired, particularly by millennials and increasingly by others. It makes no sense to not assume that, in my opinion. There are decentralized platforms. There are ways of getting rid of inefficient, expensive middlemen. I think that is something that has caught hold of the world's consciousness, and now it's being directed against those who centralize information and use it against you, as we're finding with Facebook and eventually Google. There are utility tokens, which probably have the greatest issue right now on the regulatory front, because that is something the SEC is going to have a hard time with. But there are utility tokens that matter. And then finally, there's security tokens. 3 or 4 months ago, with Bitcoin rising so much, people didn't really think about or care about security tokens. Now, there's a growing awareness that security tokens are a definite, a massive change, a massive part of this industry. And so I'm going to spend a few slides on security tokens and then stop. So, as I said, T0, Patrick Byrne will speak after me, is I believe, the leader in this. There are some other companies doing parts of it. There will be a variety of competitors. It will be a competitive market. On the other hand, it is something that I now believe is going to happen, and it's going to happen relatively soon. So ultimately, markets change when things are cheaper, faster, more liquid, when there's more information, and when the risk is usually corporates change when the risk is not to change. I think what's happening here is you're going to get enough companies or asset owners who create security tokens that at lower costs, that it's going to be learned throughout the market. One thing I like about the cryptocurrency markets and this ecosystem is how fast information gets passed around participants. And because it's liquid, each price is a signal of information. So essentially what we have here is you have an introduction of something new, and you have price signals that change, that tell people what's happening. I believe a lot of this stuff is going to happen sooner than we think. Security tokens are going to increase efficiency dramatically, removing costs, removing middlemen. Patrick will tell you more about this, but this is something that you definitely want to pay attention to for 2019. So an example is real estate. So that was the greatest asset value of all the ones I showed, 228 trillion estimate. 25% of it is commercial, that's 57 trillion. Estimate a liquidity premium captured using security tokens could be 10%, and that would equal 5.7 trillion. The point is, when something's illiquid, it usually depresses a price. If something's more liquid, it rises it. If something has a high friction or high cost, it lowers the effective price. If something has less friction, less cost, it raises the asset price. The point is, there is too much reason for owners of assets, particularly something like real estate, not to figure out a better way of securitizing it. And this is something that now makes a lot of sense to me in this digital era. Okay, last slide. I've got 17 seconds left. So unlike these other markets that I referenced, there is a dynamic which is fascinating here. the partner to the greatest investor in the world that America has named, Warren Buffett, Charlie Munger, is age 94, and he has declared crypto a fraud and a bubble. And I think he put less than 10 hours of work into it. He is 94. And he is a very, very wealthy, very, very smart individual. There's another Charlie who works in my building named Charlie Noyes, who's 18 years old, works for Pantera. I think I asked him if he had put 10,000 hours into crypto. He had to think about it because he's only 18. He went to MIT for a semester and dropped out. But he is one of two managers of Pantera's funds. And astonishing how much this 18-year-old knows in this era, generally about business and about this subject. I think institutional investors have to choose which to believe, Charlie Munger or Charlie Noyes. For myself and for you, I would encourage you to continue doing and investing in what's never happened before, because institutions are going to follow, because this is the era we're in, an era where technology changes every big sector in the world on a global basis. Thank you.